Welcome to the final reading in Level 3 Fixed Income, which is a credit strategies reading. In this reading, we move away from trading risk-free benchmark yield curves, risk-free rates, and we move towards thinking about trading credit spreads, the extra return we get in credit risky instruments due to their credit risk. There is a general idea that we can carry forward from the last reading. In the last reading, we said if risk-free rates are falling, maybe across the curve or at a particular maturity, then prices will be rising. Prices of instruments with exposure to those rates will be rising, and we'll be happy to take exposure there. We can carry forward this general idea into the credit risky markets and say where we expect spreads to be falling, that's where we expect the price of these credit risky instruments to be rising, and we'd be happy to take exposure there. We can bring that through. But the key idea here is we're focusing more on spreads than just, in fact, we're focusing on spreads rather than just risk-free rates like we were in the last reading. Of course, we know what credit risk is from previous levels. Here in the Level 3 curriculum, they start off defining credit risk in its most narrow form. Some people would refer to this as default risk, just the risk that you don't get paid back. Later on, they loosen that up a bit and say generally credit risk is that, but also the risk that a credit ratings downgrade or just general deterioration in investor appetite for credit risk causes spreads to widen and you lose money. Don't forget, spreads widen, prices are expected to fall. So it includes that as well in a more general definition later on. But yes, if you like, the nucleus of it all is that the issuer of a credit risky instrument fails to make payments that it's promised under the bond. Of course, we're moving away from government and sovereigns here, which can, entities which can create their own currency, and we're moving into corporate sector and other type of issuers that can't create currency, and so credit risk is a bigger issue. When we move away from sovereigns into corporate sectors, we tend to be looking at smaller issuers and smaller bond issues themselves. So they might not trade as much liquidity risk, or liquidity itself might be more of an issue. Liquidity risk, of course, is the risk that you can't buy or sell the security without offering a significant concession to the other side. And so that might be more of an issue in the credit risky bond market, the corporate bond market, essentially. Now, we're going to refresh. You might remember from Level 2 credit risk modelling, that was quite punchy, quite spiky. We're not going to do that modelling at Level 3, but we are going to remind ourselves of the key ingredients that go towards credit losses. All right. The key ingredients really are here. The recovery rate. Don't forget, with even the most credit risky of issuances, if there was a default, you might well expect to get some of your par value back in the event of default. So that's what the recovery rate represents. It might be 12 cents on the dollar, something like that. From a credit risk perspective, it's actually the loss given default, which is 1 minus that recovery rate, which would be 88 cents on the dollar. That's really the key ingredient going into your credit risk assessment here. Of course, you've also got the probability of default, which will be like a small percentage, 0.5%, something like that. That is periodic. That's the chance that the issuer defaults within a certain time frame, okay, which is also linked to the spread, because the spread will be a required return for a certain time frame, usually per annum, per year, right? Now, these are the two key ingredients: loss given default and probability of default. But if you scale it up by your exposure, your expected exposure at default, then you can multiply these three things together, 0.88 times 0.5% times whatever